Hello traders, welcome back to Alpha Market Meridian. Nikkei 225 just rip higher by 3,320 points. That's 5.58% in a single session, the biggest one-day gain we've seen in months. Price printed 63,091, a level not visited in over a year, and retail traders are full-on euphoric right now. But here's what most of them are completely missing. On the daily chart, every moving average from the 5-day all the way to the 200-day remains locked in bearish alignment. The 4-hour MACD is already rolling over even as price peaks above 63,000. If this is a classic bull trap, the downside unwind will be extremely violent. Today I'll break down the exact price levels that separate a genuine breakout from a distribution top. Stick around until the end. I'm sharing 3 complete trade setups for conservative, standard, and aggressive traders, with clear entry, stop loss, and take profit levels ready to execute immediately. Here's our high conviction market red straight up. Nikkei 225 is stuck in a massive tug-of-war, a strong daily bear trend fighting against a powerful short squeeze impulse. Multi-timeframe structure confirms the dominant trend stays bearish unless we secure a daily close above 63,200. Anything below that threshold, and this entire explosive surge is just a corrective bounce inside a larger downtrend. The critical line in the sand is 63,091, today's session high. A daily close above this level opens a path towards 65,000. A sharp rejection back below 62,000 officially confirms this rally as a bull trap. Every major move from here hinges on these 2 key levels. Let's dive straight into multi-timeframe technical analysis. If you're not layering timeframes, you're simply trading blind. Pull up the 4-hour chart first. Price rocketed from 60,213 all the way to 63,091 in a vertical spike. Right now, 4-hour moving averages paint a critical picture. MA5 at 60,887, MA10 at 60,275, MA20 at 59,963, and MA40 down at 58,581. We closed near 62,833, sitting over 1,900 points above the 20-period MA. This kind of extreme extension is statistically unsustainable. Historically, when price trades more than 3% above the 4-hour MA20, mean reversion hits within 3 to 5 candles. The market rubber band is stretched to its limit. Look at the 4-hour MACD. The reading sits around 1,577 with the signal line at 140. Momentum remains positive, but histogram bars are shrinking fast. Clear bearish divergence into the new highs above 63,000. Our trend oscillator summary is unambiguous. 3 buy signals, 6 neutral, 3 sell signals, with an overall bearish trend bias. Despite a 5.5% one-day moonshot, 12 combined technical indicators on the 4-hour frame confirm underlying bearish momentum. All 8 moving averages from MA5 to MA200 are flashing bearish. This internal contradiction always crushes late retail buyers chasing the hype. Now move up to the daily chart. Daily moving averages are still sloping firmly downward. MA5 at 60,230, MA10 at 60,005, MA20 at 58,893. Price is barely holding. Above them, while MA50, MA80, MA100, MA150 and MA200 form a perfect bearish descending staircase from 56,216 down to 50,302, daily MACD reads 4,448 with the signal at 3,789. Still positive, but momentum is clearly decelerating. Stochastic RSI is deep in overbought territory. The daily trend verdict remains bearish. 3 bullish indicators, 6 neutral, 3 bearish, with moving averages unanimously bearish across the board. This monster green candle has not reversed the dominant trend structure. It has only temporarily challenged it. Drop down to the monthly chart for the big macro picture. Here we see early bullish hints. Monthly MA5 at 57,090, MA10 at 52,610, MA20 at 45,581. Monthly MACD is positive at 94, with the signal line curling upward. Overall monthly trend is neutral. 2 buy signals, 9 neutral, 1 sell signal. Long-term structure is healing. but it hasn't given a full all-clear bull signal yet. Monthly RSI sits at 70, right at the overbought threshold without breaking out. This tells me if weekly and daily price can build a solid base above 60,000 in the coming weeks, the monthly trend will flip bullish. But we are not there yet. The multi-timeframe verdict is clear. Monthly shows early accumulation signs, daily remains bearish despite the massive spike, and the 4-hour frame is extremely overextended with clear bearish divergence. This is classic exhaustion rally territory, not a confirmed new bull market. Let's map out all key price levels. The upside, 63,091 is immediate. Strong resistance at today's high. Above that, 63,200 is the major structural trigger, marking a prior weekly breakdown level. A clean break above 63,200 targets 65,000, a major psychological round number, and the 38.2% fib retracement of the 2024 to 2026 decline. The downside. First support sits at 62,000, the Asian session breakout level. Below that, 60,800 aligns with the 4HMA5, and 60,200 lines up with the 4HMA10 and today's opening price. Critical major support is 59,500 at yesterday's close. A break below this level erases the entire spike and confirms a full bull trap. Bear's primary target zone lands at 58,500, right on the 4HMA40. Now let's break down the fundamental drivers behind this sudden 5.5% spike. The answer starts with the Japanese yen. Nikkei 225 and US dollar to Japanese yen move in lockstep. A weaker yen boosts overseas earnings for Japanese exporters and fuels carry trade inflows into equities. Overnight, US dollar to Japanese yen surged back above 148, and market commentary around the Bank of Japan's bond buying operations confirmed the BOJ is in no hurry to aggressively tighten policy. The market took this as a green light to re-leverage carry trades aggressively. On top of that, US markets rallied sharply in the overnight session. A cooler-than-expected PCE inflation print and renewed AI optimism pushed the S&P 500 and Nasdaq higher. As a high beta play on global tech sentiment, the Nikkei gapped up and never looked back. But most traders are missing the critical nuance here. The BOJ faces massive ongoing political pressure. Core CPI holds around 2.8%, and spring wage negotiations delivered the largest pay hikes in 30 years. The central bank's window for dovish policy is closing fast. April meeting minutes show more board members favoring earlier cuts to JGB purchases, potentially as soon as July. If that risk plays out, the yen could rally 3 to 4 big figures in days, and the Nikkei would crash 2,000 points without warning. This entire rally is built on fragile BOJ dovish assumptions that can reverse violently overnight. Institutional flows send another clear warning. JPX data shows foreign investors were net sellers of Japanese cash equities in 3 out of the last 4 weeks. This week's rally is driven almost entirely by futures short covering and retail margin buying, not genuine long-only institutional accumulation. Once short covering dries up, there is no major buyer left to sustain highs. ETF flows confirm the same story. The iShares MSCI Japan ETF saw $1.2 billion in outflows over the past month. This push towards 63,000 is not backed by traditional equity inflows. It's driven purely by derivative gamma squeezes. That is a major red flag. Let's connect the macro dots with gold and oil. Gold holds firmly above 2,750, reacting to real rate expectations and ongoing geopolitical hedging demand. Oil hovers near 82, signaling limited immediate demand fears that if this Nikkei rally is truly driven by broad AI optimism, we should see confirmation from copper. And semiconductor indices. The SOX Semiconductor Index did rally, but failed to break prior highs. Divergences across correlated assets are piling up rapidly. My 1 to 2 week base case outlook. Nikkei 225 will struggle to hold above 62,000 and drift back toward the 60,200 to 59,500 zone, entering a consolidation phase before its next major directional move. A weekly close above 63,200 invalidates this bearish outlook and flips my bias cautiously bullish. The biggest near-term risk events are next week's BOJ summary of opinions and US CPI inflation data. A hot CPI print kills Fed rate cut hopes, lifts the US dollar and US dollar to Japanese yen, and could temporarily support the Nikkei, but the subsequent unwind will be far sharper. A cold CPI print weakens the dollar, strengthens the yen, and directly pressures Nikkei upside. The next 7 days are a major macro minefield. Now let's turn all this analysis into 3 executable trade strategies, from conservative all the way to aggressive, with exact levels and strict risk rules. Grab a notebook and write these down. Strategy 1. Conservative setup. Fade the extension with confirmation. High certainty, smaller position size. The logic is simple. Wait for the overstretched momentum to show clear exhaustion before entering short. Entry condition. Enter only after a 4-hour candle closes firmly below 62,500. This level sits just under today's mid-session consolidation zone. Enter short on a minor pullback to 62,500, now flipped from support to resistance. Stop loss placed at 63,150, just above today's session high, risking roughly 650 points. First target at 61,200. Matching the 4 HMA 10 area for a 1-to-2 risk-reward ratio. Second target at 60,200, today's opening price and key structural pivot, delivering a 1 to 3.5 risk-reward trade invalidation. If price reclaims 62,800 and holds above for 2 full 4-hour candles without reversal, abandon the short setup entirely. Conservative traders should risk no more than 0.5% of capital on this trade. Strategy 2. Standard setup, trend continuation short with dynamic trailing stop. Balanced risk and reward with structural trend edge. Lean into the dominant daily bear trend and compressed moving average structure. Entry rule. Sell on a retest of the 63,000 to 63,100 zone, only if the 1-hour RSI trades above 70 and a clear bearish pin bar or engulfing pattern forms on the 1-hour chart. We need 2-step confirmation. Resistance retest plus clear rejection price action. Stop loss at 63,350, above the 63,200 structural trigger and any false breakout wicks, risking roughly 250 to 350 points depending on exact entry. First target at 61,500, a former breakout level now acting as support. Second target at 60,000, a major psychological round number and daily MA20 level, delivering approximately 1 to 3 risk-reward trailing rule. Once first target is hit, move stop loss to break even. Trail the stop 200 points above the 1 HMA20 as price declines, locking in profits while letting the bearish trend run. This setup benefits from daily and 4-hour bearish moving average alignment. We are fading retail breakout buyers and targeting their stop loss liquidity. Strategy 3. Aggressive setup. Fade the intraday pump with tight scalp. High risk, ultra small position size only. This setup is strictly for experienced risk takers betting 63,091 mark the absolute intraday high entry. Sell at market on any spike towards 63,050. Stop loss tightly placed at 63,250, just above the day's high, limiting risk to roughly 200 points. First target at 62,200. Second target at 61,800. Targeting a quick gap fill mean reversion scalp. Risk reward runs 1 to 2.5 up to 1 to 3. Win rate runs lower at 40 to 45%, so strict stop loss discipline is non-negotiable. A break above 63,250 means short squeeze momentum accelerates towards 64,000, and you do not want to be caught in that move. Only risk a maximum of 0.25% of account capital on this aggressive scalp, and accept full loss on the risk amount without emotional bias. Across all 3 strategies, the core rule remains position sizing and probability. You don't need to win every trade. You just need positive mathematical expectancy over a large series of setups. Quick critical risk management reminder. Never risk more than 1 to 2% of total capital on any single trade. When the Nikkei moves 3,000 points in one session, the temptation to oversize is huge, and that's exactly how trading accounts get wiped out. Never hold positions blind into high impact news events. Tomorrow brings the BOJ summary of opinions and US ISM services data. Major news creates liquidity gaps and heavy slippage. Your stop loss is your only survival tool. Always respect it. Let's wrap this up with a bottom line. Nike printed an explosive 5.5% green candle, but underlying multi-timeframe trends, institutional flows, and yen macro dynamics confirm this rally is running on fading momentum. 63,091 is the bull's critical defense line. 62,000 is the bear's gateway. A daily close above 63,200 rewrites the trend story entirely. A firm rejection below 62,000 triggers the bull trap unwind. Tomorrow I'll closely monitor how the market digests this massive spike, especially where the US dollar to Japanese yen holds above 148 and if the S&P 500 sustains its own breakout. I'll cover every critical price flip right here on this channel. Now drop a comment below. Are you buying this Nike surge, or fading it? Leave your long or short bias, plus the exact invalidation level you're watching closely. If you found this breakdown valuable, hit the like button, subscribe to the channel, and turn on notifications for daily institutional grade analysis across all major assets. This is Alpha Market Meridian. Trade the algorithm, not the emotion. See you in the next session.